Uh, Good morning, everyone, and a very warm welcome to today's webinar. It's a pleasure to have you all with us. As a part of our webinar series, we aim to provide investors with structured insights and actionable perspectives to help investors navigate evolving market conditions. In recent times, global markets have been shaped by heightened uncertainty, ranging from geopolitical tensions to fluctuation in oil prices and shifting economic dynamics. While such phases can be unsettling, they often create meaningful opportunities for long term investors who stay focused and disciplined. Today's session is centered around the theme Uncertainty and Opportunity. We will explore how markets have historically navigated period of conflicts, the interplay between war and commodities like oil, and what this means for today's investors. We are delighted to have with us Mr. Sandip Agarwal, co-founder and fund manager at Sowilo Investment Managers, who will share his perspectives on recent geopolitical developments and the potential impact on Indian equity markets. Joining him is Ms. Padmavati Udecha, Head of Research at Sowilo, and Mr. Ariman Ariel. They will add valuable insights to the discussions. Today's session will cover the following themes: war, oil, and more. Market outlasts conflicts. Portfolio, navigating the straits of market. Dear participants, if you have any questions during the session, please feel to drop them in the chat box. We will be taking them in the Q&A session. With that, I now hand over to Mr. Sandip Agarwal to take us through his views. Sandip ji, you can take it forward.
Yeah, hi, good morning everyone, and thanks for coming in and joining in the webinar on a Saturday morning. We have all seen multiple challenges which has happened since the beginning of the conflict, particularly US starting along with Israel bombing Iran, and a few days back we were at the tipping point where there were some chatters of even using weapons of mass destruction by US and Israel in the Middle East, and which was very worrying. We have also gone through how geographical blockade has been put in place to kind of negotiate, and now we are also in a situation where yesterday evening President Trump has said that we are very close to getting out of this situation. It is still a volatile situation because after he mentioned that today morning we have more updates which are quite opposite to that as well. But this things will keep on happening. Finally, we have seen in last 20, 30, 40 years data or even beyond that finally markets are basically representative of a group of companies, and the companies are basically what they are is basically they are a business enterprise which has its own revenues, growth, earnings and all, and they have their cycles. So that is the fundamental, and that remains same. Yes, sometimes there is a de-rating, what people are willing to assign, how much weight to equity. That weightage changes, which brings down the multiples or takes up the multiples, and based on that the stock prices react. Not necessarily that stock prices are only impacted by the business cycles. They are also impacted by the asset class allocation by the investors. So we will have a very interesting, we have tried to cover few of the very interesting topics along with data which is there historically, and I will just pass on the baton to Ms. Padmavati, and she will start with few interesting data points, and I and Aryaman will join later as and when required. So Padma, please go ahead. Thank you.
Yeah, thanks, Cindy, for that. And thank you everyone for joining this morning in our webinar. So just quickly, before I begin with some of these interesting data points, I just want to re-emphasize the 5 key pillars that we here at Sowilo follow in terms of our key investment philosophy. So scale, returns, technology, leadership, and governance. I won't spend much time here because, in the past we have already discussed these in detail. And these are some key achievements which are basically accolades to our investment philosophy and the work that team here at Sowilo is doing. So now just very quickly on, as Sydney was mentioning, that we in the past little more than a month we have seen a lot of uh, negative news flow, and then there's a lot of volatility that has been there. So if you look at the crisis, the best way to actually reflect economic sentiment is the way the crude oil is moving. So if you see this chart, like from the first time when US Israel had this strike that they did on Iran, and that was the key event that triggered the war. We saw that crude, which was somewhere around 65, 70 or dollars, I'm referring to the Brent crude, shot up all the way above $100. And then intermittently, there have been a lot of volatile news flow. And then finally, we have come to a stage where last night, ये बोला जा रहा था कि यूएस इजराइल ईरान इनके बीच एक सीज फायर शायद फाइनलाइज हुआ है, और ईरान के पार्लियामेंट ने ये अनाउंस भी किया कि वो लोग स्ट्रेट ऑफ हॉर्मुज को पूरी तरह से खोल देंगे. और इसलिए जब कल मार्केट्स बंद हुए इंटरनेशनल मार्केट्स रात को, तो हमारा जो क्रूड ऑयल जो ऑलमोस्ट $100 के ऊपर स्पाइक हो चुका था, दैट हैज फॉलन टू अराउंड $80-83 और सो. अब इस सुबह हमने देखा कि कॉन्ट्रोडिक्टरी न्यूज भी आया है कि ईरान इज सेइंग कि नहीं हम फिर से बंद कर देंगे. सो बहुत ही ज्यादा वोलेटाइल है. बट हैविंग सेड दैट, आई थिंक द वर्स्ट इज रियली ओवर. अभी यहां से नेगेटिव न्यूज फ्लो आना थोड़ा कम ही है, बिकॉज जो एक्सट्रीम हमने नेगेटिविटी देखी थी, जहां एक पॉइंट पे ट्रंप ने ये तक थ्रेटन कर दिया था कि शायद हम लोग मास डिस्ट्रक्शन वेपन्स यूज कर लेंगे, तो वो पॉइंट वॉज द पीक ऑफ द क्राइसिस. अब क्या हुआ है कि अब ये थोड़ा टू एंड फ्रो होते रहेगा कि ईरान कुछ बोलेगा, यूएस कुछ मांगेगा, तो ये नेगोशिएशन में होगा, एंड देन फाइनली दे विल कम टू सम सीज फायर व्हिच कैन स्टे. Key to watch obviously will be how does Israel really behave in this whole equation. अब ये हमारे लिए क्यों इतना इम्पोर्टेंट है, क्यों हम इतना मतलब क्रूड ऑयल प्राइसेस से इतना क्यों हम अफेक्ट हो रहे हैं. तो इसीलिए हमने यहाँ दिखाया है कि इंडिया क्या है, कि इंडिया ऑलमोस्ट 88% ऑफ हमारा जो क्रूड रिक्वायरमेंट है वो हमें इंपोर्ट करना पड़ता है, क्योंकि हमारे पास तो इतना कुछ है नहीं. सो दिस इज द की रीजन व्हाई when crude oil sees a huge spike, India is affected at all levels, like whether it's Indian household, चाहे वो बोलते हैं ना जो villages में जो रहने वाली जो गृहिणी होती है उनके लिए भी अफेक्ट करता है, बिकॉज उनके एलपीजी प्राइसेस बढ़ जाते हैं, या फिर अगर कोई कॉर्पोरेट है उनको भी अफेक्ट करता है क्योंकि उनके लॉजिस्टिक्स कॉस्ट बढ़ जाते हैं, बिकॉज दे आर यूजिंग फ्यूल. या तो फिर देयर आर सो मेनी इंडस्ट्रीज वेयर they are dealing with crude oil derivatives. The products itself that they are manufacturing, उसमें crude is used as an input. तो ये डायरेक्टली कॉर्पोरेट्स के मार्जिन को अफेक्ट कर देता है. फिस्कल गवर्नमेंट फिस्कल कैलकुलेशन भी हिल जाता है पूरा, बिकॉज क्या हो जाता है कि आज भी क्रूड को हमें सब्सिडाइज करना पड़ता है, क्योंकि अगर क्रूड ऑयल जैसे इंटरनेशनल मार्केट में अगर 70 से 100 के ऊपर चला गया तो हम पेट्रोल और डीजल के दाम तो वैसे नहीं बढ़ा सकते पब्लिक के लिए, तो इसीलिए फिर गवर्नमेंट को आके सब्सिडी देनी पड़ती है, तो उनका सब्सिडी बिल भी बच जाता है. सो दिस इज वन एलिमेंट व्हेन इट मूव्स अप शार्पली, इट अफेक्ट्स एवरीवन, लाइक एब्सोल्युटली एवरीवन. आगे जाके हम देखेंगे वेबिनार में कि कैसे ये ज्यादा टाइम तक एलिवेटेड रह नहीं सकता, तो उससे हमें बहुत ज्यादा पैनिक करने की जरूरत नहीं है. बट बिफोर वी मूव ऑन टू दैट सेक्शन, लेट अस जस्ट डिस्कस कि हमारे जो मेजर इंडाइसेस है इनकी मूवमेंट कैसे रही है ड्यूरिंग द वॉर. तो आप अगर देख सकते हैं तो हमने यहाँ निफ्टी, एनएससी मिड कैप इंडेक्स और एनएससी स्मॉल कैप इंडेक्स का चार्ट बनाया है कि इसमें कैसे मैक्सिमम ड्रॉडाउन हुआ. तो हमारा ये जो भी क्राइसिस हुआ इसमें लगभग 15 to 16% काइंड ऑफ ड्रॉडाउन हुआ था निफ्टी और मिड कैप इंडेक्स में, और स्मॉल कैप तो ऑब्वियसली लाइक थोड़ा ज्यादा ही आइडर साइड पे स्विंग होते हैं, तो वहां लगभग 20-25% काइंड ऑफ ड्रॉडाउन हुआ. और इन लेवल्स पे वैल्यूएशंस काफी अट्रैक्टिव हो गए थे, और इसीलिए हम देख रहे थे कि वहां से gradually things started recovering, and this also coincided with the fact that war news, from extreme negativity it started swinging to positive news. So भले वोलेटाइल है, आज भी एक हेडलाइन आता है सीज फायर का और फिर एक कॉन्ट्रोडिक्टरी हेडलाइन आ जाता है, लेकिन हमें ये जानना बहुत जरूरी है कि worst is over. So this is a consensus that is actually being बिल। और अगर हम सेक्टोरल इंडाइसेस देखेंगे तो हम देखते हैं कि बैंक निफ्टी, ऑटोज, दे हैव बीन द वर्स्ट ड्यूरिंग दिस होल पीरियड। और even other, like otherwise, like for example INR saw sharp depreciation, और अगर आप 10-year bond yields देखें तो ये भी काफी शूट अप हो गए थे क्राइसिस के टाइम। तो across the board we saw pain, but now things have started rebounding। और एक चीज जो मतलब मैं ये कहूंगी कि it is not just a result of the war, but something that we have been seeing over the last couple of years, कि क्या हो रहा है कि FIIs जो है ना वो कंटिन्यूसली इंडियन मार्केट से पैसे निकाल रहे हैं। सो व्हाट हैपेंस इज कि हमारे नेट FDI फ्लोज भी इस समय इतने स्ट्रांग नहीं है, और इसके साथ साथ FIIs कंटिन्यूसली पैसा निकाल रहे हैं। तो इससे क्या हो रहा है कि हमारा जो कैपिटल अकाउंट है that has slipped into negative in the first time in over 25 years. So this also adds pressure to the करेंसी। नहीं तो क्या होता है कि अगर आपका क्रूड बढ़ भी जाए लेकिन अगर आपका कैपिटल अकाउंट पॉजिटिव है तो वो क्वेश्चन दे देता है। तो ये एक रीजन था कि हमने इतना शार्प डेप्रिसिएशन देखा हमारी करेंसी में। अब प्रश्न, एक क्वेश्चन आएगा जो इन्वेस्टर्स के माइंड में रह सकता है कि वाई ऑयल का हम पे क्या इम्पैक्ट होगा। तो जैसे मैंने बताया कि when oil prices go up, it affects everyone. It affects households, it affects corporates, it affects the government. लेकिन ये जो oil price rise होता है ये अलग अलग कैटेगरी, मतलब ये किसके कारण ऊपर जा रहा है उसके बेसिस में इसको हम अलग कैटेगरी में डिवाइड कर सकते हैं। लाइक फॉर एग्जांपल 2006 to 8 पीरियड में भी ऑयल प्राइसेस काफी ऊपर गए थे। लाइक आप अगर देखेंगे ये चार्ट लेफ्ट साइड पे $60 से ऑलमोस्ट $135 चले गए थे। बट ये क्या था, ये डिमांड शॉक था। इस समय ग्लोबल डिमांड इतनी ज्यादा स्ट्रांग थी कि उतना करस्पॉन्डिंग सप्लाई नहीं था ऑयल का, और इसलिए प्राइसेस वर गोइंग ऑल टू ओवर द रूफ। As a result, we didn't see any pressure on the CAD. We didn't see any मतलब INR depreciation तो छोड़ो appreciate हो गया था। तो that was in a time when economy was very strong. So this oil prices going up was easily absorbed. लेकिन करंट कॉन्टेक्स्ट या ऐसा ही एक सिचुएशन रशिया यूक्रेन वॉर के टाइम भी हुआ था, पहले भी हुआ है। अगर आप देखें एक पीरियड था जो मतलब 21-22 में, वहां भी ऑयल प्राइसेस शूट अप हुए थे उस समय, लेकिन सप्लाई शॉक था। तो जैसे ही सप्लाई शॉक हुआ हमने देखा कि कैड वाइडन हो गया, INR डिप्रिशिएट हो गया। तो इंडिया या इंडियन इकोनॉमी के पर्सपेक्टिव से अगर हम समझना चाहें तो ये पॉइंट बहुत इंपॉर्टेंट है कि ऑयल प्राइस राइज इज ड्रिवन बाय व्हाट, इज इट अ डिमांड लेड राइज और इज इट अ सप्लाई शॉक थिंग। तो अगर ये सप्लाई शॉक होगा तो इट अफेक्ट्स अस नेगेटिवली, और ये चीज हमें बहुत ध्यान रखना पड़ेगा। अब सेंसिटिविटी, कई बार लोग पूछते हैं कि क्या सेंसिटिविटी है, तो ये इस स्लाइड पे मैंने ब्रॉडली वो सेंसिटिविटी दिखाई है कि अगर आपका क्रूड ऑयल $10 पर बैरल बढ़ता है, लेकिन ये सस्टेन होना चाहिए, मतलब कि वॉलेटाइल, जैसे अभी लास्ट 1 महीने से तो ऊपर ही है क्रूड, बट अगर मान लीजिए नेक्स्ट 1 महीने में वापस नॉर्मलाइज हो जाता है देन इट्स ओके, देन इतना ज्यादा इम्पैक्ट नहीं आएगा। बट मान लीजिए ये सस्टेन रह गया like over let's say 6 months to 12 months, then every $10 rise will affect, whether it's excise, whether it's fiscal, whether it's inflation, whether it's trade deficit, हर जगह पे इसका इम्पैक्ट आएगा। अब जैसे कि हम बोल रहे हैं कि जो वॉर है इसमें द वर्स्ट इज ओवर, सो व्हाई आर वी सेइंग दिस, मतलब हम कोई एस्ट्रोलॉजिस्ट तो है नहीं, या एक बोलते ना वो हमारे पास वो बॉल तो है नहीं कि हम उस पर गेज करके बताएं कि अभी आगे क्या होने वाला है। बट प्योरली फ्रॉम एन इकोनॉमिक स्टैंड पॉइंट इफ आई वर टू टॉक, देन क्या होता है कि द कॉस्ट ऑफ इंटरसेप्टिंग अ ड्रोन और द थ्रेट दैट इज कमिंग इज मच मच मोर। तो अगर आप ये देखें जो कॉस्ट डिफरेंस है, ये ईरान का ड्रोन है और इसके कंपैरिजन में अगर यूएस का इंटरसेप्टर आप कॉस्ट देखिए तो ऑलमोस्ट 60 टाइम्स का डिस्पैरिटी है। तो कितना टाइम तक यूएस ये ड्रोन्स को इंटरसेप्ट करते रहेगा। सो ये जो बात है ना, ये वॉरफेयर की इकोनॉमिक्स है, जिससे कि इट इज वेरी वेरी अनलाइकली कि आप ज्यादा टाइम तक वॉर को खींच सकते हो। सेकेंड, ये जो यूएस मिलिट्री इक्विपमेंट्स है, दे आर हाईली डिपेंडेंट ऑन रेयर अर्थ्स या क्रिटिकल अर्थ्स जो बोलते हैं, और ये कहाँ से आता है, यूएस के पास पूरा नहीं है, 70% इज इम्पोर्टेड फ्रॉम चाइना। And China in general, like across the world, it has the highest volume of rare earths that have been mined. So इसीलिए चाइना का रोल बहुत इंपॉर्टेंट हो जाता है. एंड वी ऑल नो ऑल्सो कि चाइना इज नॉट जस्ट अ सप्लायर ऑफ रेयर अर्थ्स विच आर यूज फॉर यूएस मिलिट्री इक्विपमेंट्स, बट चाइना is also in ally with Iran. So, from that perspective also, it is unlikely that the war will get prolonged for a very long time. So these are the economics of warfare. And this is a core reason why we believe, या हम बहुत strongly ये मानते हैं कि the worst is over when it comes to the war. So with that, I think I will pass it on to Sandeep, and he can actually start discussing a few interesting trends which are beyond this whole war noise. So yeah, over to you, Sandeep.
Yeah, thank you, Kalma. Thanks for the very good insights on these slides. So, two, three things which I want to add on beyond what Padma said. That as I mentioned, that we always evaluate companies based on their performance of revenue and all. So this kind of geopolitical things or war kind of situation, when it happens, then the biggest challenge which happens because of this is that you are stopping the oil to flow, and oil is not only to be seen as an energy source, but oil also has a lot of derivative which is used across industries. So ऑयल के प्रोडक्ट्स पेंट इंडस्ट्री में यूज होते हैं, कोई भी प्लास्टिक इंडस्ट्री में यूज होते हैं, बहुत जगह यूज होते हैं, उसके डेरिवेटिव्स ऑलमोस्ट बहुत सारी इंडस्ट्रीज को इम्पैक्ट करते हैं. सो एक तो वो बहुत बड़ा इम्पैक्ट है. सेकेंड, जब आप इस तरह से कंस्ट्रेंट लगाते हो देन वेसल्स पे, बिजनेस पे बहुत प्रॉब्लम आता है, फेयर्स बढ़ जाते हैं, इंश्योरेंस कंपनीज आर नॉट विलिंग टू टेक द कवरेज, तो उसके कारण भी आपको वेसल नहीं मिलते हैं, आप ट्रांसपोर्ट नहीं कर सकते सामान का. तो मेरे को लगता है कि अभी वर्ल्ड ओवर जो जितना ग्लोबलाइजेशन हुआ है, पीपल आर डिपेंडेंट एंड ऑन ईच अदर फॉर एवरीथिंग, उसके हिसाब से इट इज वेरी टफ टू स्टॉप एनी पासेज ऑफ एनी goods globally, and it is, I think, very unethical and a big challenge. But unfortunately, people use this as a negotiating instrument. तो अगर आप देखेंगे, there was a resolution which was brought to the United Nations that you cannot use Strait of Hormuz for blocking, and unfortunately Iran obviously will object to it, but they were supported both by China and Russia. So you can imagine, रशिया को तो फायदा होता है, ऑयल का प्राइस इतना ऊपर जाएगा, उसका तो बहुत फायदा हो रहा है. एंड चाइना बीइंग एन अलाई ऑफ ईरान एंड आल्सो वांटेड टू सपोर्ट, तो उसने भी उसको विटो किया यूएन में. So these are things are very complicated, and everyone has their own vested interest, and because of that, sometimes things look tough. But let me put it this way, that we have seen in the past that if you leave aside the Ukraine-Russia war from tenure perspective, and if you see the intensity perspective, I think वो भी बहुत दिन नहीं चला था. Secondly, वार में जो हमने हमेशा देखा है, जितने भी वार पास में हुए हैं, when whoever is on your border, he will be very dangerous irrespective of the kind of weaponry he has. तो उसका कोई फर्क नहीं पड़ता. आज if you see जेलेंस्की का एक इंटरव्यू था जब वो डोनाल्ड ट्रम्प से मिलने गया था यूएस में, तो ट्रम्प ने जब उसको थोड़ा ठीक से बात नहीं की, when he did not give him respect, then he said only one thing, that president, you can speak like this because there is a 12-hour ocean between you and the other countries, and so that protects you, so nothing can reach you easily and everything can reach us very easily. So the difference is ki if there is someone who is very close, then a very small kind of weapon can help, and that is what is happening with drone. So I think if you see why Iran is hitting the bases, nearby bases and the allies of US, because that is what they can hit with small weapons and low cost, but US will have to intercept. So interception is always very expensive, although there are a lot of work happening in defense tech globally, and we can take that separately, but that is what is also happening. So we have to see from all the perspectives, but broadly what we have seen is that this conflicts, because of so much of globalization and interrelation, they don't last for long, because some or other party starts to pacify, and when the country starts getting impacted, the economies start getting impacted, then everyone come together and try to solve it, and that is what we are seeing right now also. Padma, can you take the next slide, please? So this is a slide which I would suggest, Aryaman, you want to take this one?
Sure.
So you might all be aware, in the last 1 year we have seen tech stocks rally up quite a lot. Major stocks like Nvidia, like Google, and many private stocks as well, like OpenAI, Claude, Anthropic, they've all rallied quite a lot. But since then, there have been a lot of updates, whether it be Google's update on memory or any other update. These have compressed the value of these stocks quite a lot. हम जो AI bubble की बात कर रहे थे, it seems finally it's showing cracks, and we have seen the drawdown has come down, has become quite large now. Now this is mainly because, not because fundamentals are being broken. हम लोग हर बार देखते हैं from the Bloomberg estimates, सारे all of the companies are overperforming, but the valuations were too high. Nvidia trading at 50-60 times, all of these other smaller companies trading at 100 to 200 times. These are not sustainable valuations. And finally, now we are seeing that these valuations are coming down. And given the chart that you can see, the IGV software ETF, which tracks all of the main software and AI companies, उनका drawdown आप देख सकते हैं, it's now almost 35% since September 25. So we are finally starting to see cracks in this AI hype that has been building up, and we are finally starting to see more sane valuations, and do expect this to go down further as more and more updates come out, and I'll talk about this in a later slide as well.
Yeah, go to the next slide. Padma? Yeah. So now this is a very interesting slide, because if you see after June 24, 3-4 months after June 24, that is broadly in October, there was a slow tightening by RBI, because of which we have seen a sharp fall in the credit growth, and that also has impacted the MSME businesses. But now in last few months, RBI not only has cut rates sharply, but they have also taken a lot of measures to revive the liquidity and credit growth, and that is quite visible if you see that chart which is on the top. We are again started seeing 14-15% kind of credit growth, which is very, very healthy, because it also reflects that businesses are borrowing, businesses are investing money in working capital, in capex and all. So it is a very good sign. Second, mortgage loans also, if you see, which has a very big impact on the real estate construction, and also in a way household wealth, that was also lagging in early 2024 to 2026. It fell to 11% from 20%, but we believe that there will be some transmission here also, and this will also help. So some initial green shoot of data has started coming in. Also, if you see some of the sectors which have benefited a lot because of the GST cut, like the real estate and the steel consumption, the where demand was looking little weak, but after the cut in GST, they have also started showing early signs of revival, and I think that will be more pronounced once this conflict gets over, because then the confidence and decision making will be much faster than earlier. Right now, it is kind of just in time order. That will also change. Padma, next. So this is one very interesting slide that the FII and DII. These data, if you see of March 2024, the NSE mid cap 15%, NSE small cap 13%, and Nifty 50 26%. And now that data, there is a slight change in December to 16% and 14%, and the weightage of Nifty has remained same. Now, if you see the same data for the DII, you will see there is a substantial jump towards mid cap and small cap. So there is a shift, clear shift, which is happening there, and we believe that this is the primary reason, and we will cover this more in detail in our Sowilo strategy slide, which comes next with data, so that you get more clarity. But we believe that people are trying to look at high growth companies, and which can give outsized returns in terms of business. So more profit growth and more revenue growth, because as our economy size increases, some of the businesses will start maturing, the growth rates will fall. Next, Padma. Yeah, so this is again a very, very interesting slide. If you see post-COVID, just on little bit of announcement of some discovery on the drug side, and even before that, when the lockdown was announced, things started stabilizing and improving. So much before COVID peaked. So people always try to look forward looking situation and not the current situation. And once that they believe that this at current multiple the worst is priced in, the things start moving very sharply. And we have seen that multiple locations in the past, and this time also. I think when the nuclear chatters were, or the weapons of mass destruction chatters were at the peak, that is the day when I think the markets made a bottom, and then they started recovering, and things have since then improved. You may not see so much improvement in the headline indexes, but in the mid and small size indexes, there is substantial improvement from bottom. Yeah. Oh, after this, Padma. Yeah. So this is another interesting table. Since March 2nd, we have seen 27 trading sessions, and market breadth has been negative. So that is the beginning, right? And there was a sharp correction. Over 96% of the stocks have fallen. And then if you see data a little more detail, you will see that there has been returns from some of the stocks which is outsized, particularly the metal side. There has been a huge return, and other than metal, also there were few other sectors where we have seen substantial outperformance, like the IT index also have shown some amount of outperformance. So always whenever markets fall, even if there is a broad based fall, there will be someone which will gain. And we have seen that after this conflict there was a lot of beneficiary in the commodity side. So whether they are ferrous, non-ferrous, and also defensive names like IT, because they are natural beneficiary of the INR depreciation. Ayaman, next. Sorry, Padma. Ayaman, you cover this and then I come back.
Yeah. So coming back to what I was saying earlier, since we last talked, there have been quite a lot of developments in AI. Claude has come out with 2-3 models. GPT has come out with 2-3 models. Everybody is at the forefront of the race. But now a very interesting development that has happened recently is that Claude had announced a new model called Mythos. Now, usually it is a rat race in AI. Everybody is trying to one up each other and trying to get to the latest model. But this was the first time in almost 7 years that a company did not release their model to the public. Why? Because it was too dangerous to release. The model was able to find multiple security flaws and was capable of detecting and weaponizing thousands of critical bugs across major operating systems. Now, if such kind of power is put into the hands of the public, this means that all of the internet will be in a wide scale issue. A major issue will happen throughout the internet. So what Anthropic did is that they only released it to 50 tech firms, and under Project Glasswing, they only gave access of this model to certain marquee companies like Microsoft, Nvidia, Cisco, etc. So why does this matter? AI has always been at a point where it was released to the public openly, and we were allowed to use whatever was the latest and the best. But now it has come to a point where these models are getting so powerful that it is not safe to release these models to the public. And that begs the question that how is this landscape changing? If models have become so powerful, how do we see this going forward? And then on the supply side, coming back to what I said about earlier about AI valuations. Now, Google made memory less essential. Why is memory important? If you have looked a bit at the markets in the last 2 years, the prices of RAM, which is memory, has gone up 3 times. No asset class has moved as much as RAM has. And this is quite an underlying metric, because almost every single AI model, every computer uses RAM, but nobody uses RAM more than AI does. And therefore, we saw multiple of these stocks which could do memory, like SanDisk, go up crazy amounts. Now, what has happened is that Google came out with TurboQuant, which was a breakthrough research that AI now needs 6 times less. It needs 6 times less memory to work. What does this mean? Basically, everybody who was saying that we need memory now does not need that requirement anymore. The supply paradigm has shifted in a great way. So this means more AI is available to the consumer. The AI shortage has gone down, more chips, and therefore higher prices have now gone down. So Micron crashed 14% because of this in 48 hours. Around $25 billion of market cap was removed. And this was classified as Google's DeepSeek moment. When DeepSeek came into the market and China entered the AI market, everything became super cheap. All of the valuations had eroded. And we are seeing this again. If AI becomes cheaper and more available to the public, that means that these valuations will come down. The valuations are primarily hinged on AI being a scarcity. But if memory stops being scarce, then AI stops being scarce. I'll hand it over back to Sir and to discuss Sowilo strategy.
Yeah, so we will quickly spend 5 minutes in next 3-4 slides, and then we will open the floor for questions. So there has been a lot of chatter that India is the worst performing market in last couple of years and 18 months actually. So if you see the data, we are just up 4%, and there are markets like Korea which is up 146%, Taiwan 85%, and you can see the numbers there. But I would like to only highlight that if you see these markets, they are not proper investable markets. They are opportunistic market where you can get in and get out. So if you see India, for example, we are a very, very diversified market. If you see, our banking is like 20%, our insurance is 5-6%, all components together of BFSI is 36-37%. Then we have technology exposure, we have pharma exposure, we have manufacturing exposure, we have FMCG exposure, and more than that, we are a self-dependent, and most of our demand comes from internal, barring sectors like pharma and IT. So we are also a consumption economy. Now, if you compare this data, for example, with Germany, so it is a very, very heavy export heavy economy where they are totally dependent on exports and ERP and some of the technology stuff like Siemens, SAP, the auto industry. Now that has done like even 13% return. Then you go to Hong Kong. There again, Tencent, Alibaba, those 2-3 companies are broadly 20-22%, and these are companies which are regulated by China. So again, 20% return has happened, but the risk which investors have taken is a different kind of risk. It is a smart money which has moved in and moved out. Now Spain, if you see, very, very high weight on couple of companies. Again, very high risk. You can't have such high weight to 2 companies. Then if you see Brazil, again with a lot of currency volatility and other problems, and heavily commodity driven economy. Then Japan, again massively export driven auto, and some in financial and some in technology. Then Taiwan, which is 85% up, it is mostly dominated by TSMC, which is the semi chip one, which is 40%. And then you have Korea, which again single stock dependence so high. Samsung is 26%. So you can trade in and trade out when you feel that the prices are very low and you can make some money. But these are not structural market, and that is the reason they are always massively cheaper than India. So we keep on getting a lot of argument, which is very funny on WhatsApp and some media channels and Facebook and Twitter, that we are still very expensive. Some people do say that, but it is very, 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 very bad way of looking at it, because if you see even human body or anything on earth, it needs a very balanced approach. Our body needs protein, vitamin, carbohydrates, water, air, everything. You can't have only proteins and call that this is a good body. So same way markets, we have to have diversified market with diversified demand, with diversified exposure of financials, of the country's financials. And that, if you see, I honestly don't think any of the large economy of India size or comparable economy is so well balanced. Yes, I'm not denying that in 5 or 7, 10 years there will be one year when you will make a good amount of money by trading in and trading out, but it cannot be true every time. So, and again, while we have tried to put 1 year performance, because that is what people are today comparing. But if you see, I was just doing some math today morning, and I will share that data also right now with you. If you see, from April 2020 to March 2026, India has given a 17-18% CAGR, which is compared to S&P, it is 11-12%, and if you compare it with FTSE, which is 6-7%. Hang Seng, by the way, which is showing here 21% in last 1 year, last 6 year return is 0 or negative CAGR. Shanghai has given 1% CAGR. Brazil is 11-13, and Nikkei is 17-19. So we are just comparable probably in last 5-6 years to Nikkei. And prior, if you take a longer term data, you will see we are much better than even Nikkei. The point we are trying to say is that 1 year, yes, we have underperformed massively, but in last 6 years also we have done massive outperformance across every country you can think of. And this also you have to remember that this Taiwan, Korea outperformance is also led by two things. One, massive undervaluation. Second, the AI race that led to the demand for the technology products. So by the way, I have covered technology for 25 years now. Hardware demand has come back after 2003 for the first time. So after 20 years, people are spending on the hardware. So you saw a kind of outperformance. In my view, and I am not an expert on Korea and Taiwan, but let me put it this way: it will be very hard for them to continue outperformance for long, and I think there could be a reversal trade in a very big way. Right now, Korea is like 16-17% of the MSCI basket. We are 15%, and I think the day Korea starts underperforming, you will see a huge flow of money which will come to India. So there are also lot of comments which come on social media saying that the capital gain tax should be removed, and because they lose on taxes, they lose on dollar and appreciation and all. That is true. Obviously it all brings down your returns, but I still believe that as long as you are able to grow faster, so our economy, let's say, grows at 6.5, 7, and with 4-5% inflation, you are 10-11% nominal GDP growth, and with a higher per capita income, we can think 14-15%. I don't think any other country in the world of our size can offer that on a sustainable basis. So yes, we have some pain in last 18 months, but that is a transitionary pain. We are very confident that going by the micro of the data which we cover, I think we are in the best spot across globe compared to any other country. So we will see that this all underperformance being covered very sharply in next couple of years. That is what the sense is. Next, Ariman, Padma, sorry. Yeah, so this is a very interesting slide which we are working, which we have done, made a special effort to put this time. So, there is another argument which always keeps on happening: what to buy, mid or small or large, and everyone has different view, but we would like to share some view. So we were doing a lot of work on each sector, and you will be surprised to know the biggest sector, which is the bank. So if you see last 3 years almost now, PSU banks have been consistently gaining market share versus the private bank. And why they are able to gain market share? Primarily because the PSU banks are okay with 1% return on asset, while private banks want 1.8%, 2% kind of ROA. Second, so what is happening is that PSUs are undercutting the deals, undercutting the rates. A large private bank like HDFC may not be interested to do a 7.2, 7.3, 7.4% business, while PSU like Bank of Maharashtra will be happy to do at even 7.1% for home loan, for example. So the challenge is that what is the reason why they are able to do and why private is not doing? Because private has committed since last 10 years, that 20 years, that they want their ROA to be higher than 1.4, 1.5%, while PSU has not committed any such thing, and that's the reason they have. And we have that data also. They have gained huge market share. The PSUs have gained huge market share on the credit growth side, particularly from the retail side. And if this continues, so there are two options with the private banks. One, either they bring down their ROA expectations, which will lead to derating of the banks, of the private banks. The other option is that they compromise a little bit on the credit side, so they allow some lower credit profile business to happen. If that happens, then again because of the higher credit cost, people will bring down their multiple. So I think for banks, it will be very, very selective, one or two banks which will do well. We believe that Axis Bank, RBL Bank should do well because both are smaller in size. They are not at 40 lakh, 30 lakh crore of loan book and all that. So there is a chance that there will be some outperformance. But more bullish we are within the BFSI space is on the housing finance companies, because there the NIM is so big that you can afford to have some delinquencies, and also that is a business. If you are below 7-8 lakh size, 10 lakh loan books, average loan ticket size, then obviously you are not competing with the banks, because for banks to reach out to those areas and do any kind of undercutting is very tough. So we believe that for banks it will be selective banks which will do well, and hence we believe that it will not be a big mover to the Nifty. Second sector, if you see IT, I have said multiple times in last 14 months that we are very bearish on IT. We don't have IT any which ways. We have very small position in one or two AI stock. They have also not done well actually. But after 40% correction in IT index, now we believe that IT can make 20-30% quick return because of multiple levers of INR depreciation and some growth which is also coming back, because as Ariman said that some of the hype of AI is going down. In FMCG, we have always reiterated, I would reiterate, they have only two modes, which is one, their distribution network, and second was their brand. Now, in distribution, quick commerce like the Zomatos and the Instamarts have killed the edge of the distribution. So now distribution is not at all an edge for FMCG companies, and their brand premium which they used to get, that is also gone, because now the outsourced contractor, I'm sure many of you would be knowing that most of the companies get all their products, broadly 80-90% of the products manufactured at from outsourcers like Hindustan Foods and other companies. So the same vendor is producing goods for both of them, and so a bourbon biscuit will cost you 20 rupees, but a look-alike in Vishal Mega Mart will probably cost you 10 rupees. So it is very difficult for them to compete, and that is the reason so much of white labeling is happening, and that is the reason you are now not seeing even pricing led growth in FMCG. What they are getting as pricing led growth is by reducing the grammage. So we continue to be negative on FMCG. We continue to be only have a little bit of return window in IT. Banking will be selective. Chemicals, again, if you see last 5-6 years in the global capacity, chemicals also, I don't think the multiple we are getting now, it has corrected a lot. That still after correction also these multiples are sustainable, because what happens, chemical is global commodity which is largely controlled with oversupply by China. So what happens in one quarter, sometimes they take a call that they don't want to sell cheap and they stop, and as soon as they stop, because the prices in Europe shoots up, so we are big beneficiary, and the margins go up by 7-8%, which will happen probably in Q4 or Q1. And that is the time when people again go back and say that this is a high margin business, so multiple should be high, profit growth is high, and they keep assigning 40-50 multiple, which we don't believe, because we believe that it is a commodity business, can be a trading bet, but cannot be a high margin, a high multiple business. Coming to oil and gas, again, it is a trading, in my view, again, it is a trading bet, because government, despite multiple promises in the past, has not been able to make it independent. Whenever there is a stress, they come and control their prices. So right now, once oil comes down to 65-70, I think there could be some money to be made there. Next slide, Padma. So what we continue to like manufacturing capital goods, because China plus one is a real theme. Job creation also happens more with manufacturing and infra. So we believe these two sectors will do very well. Obviously, they are very volatile and they fall very sharply, which we saw in last 18 months, but they recover also very sharply. Pharma, we are the pharmacy of the world. No one can change that, in my view. We have huge advantage. So that is one sector which we like a lot, and we have seen we did some lot of cherry picking in that space at a very reasonable valuation, and that is doing very good for us. Auto ancillaries we like a lot, because auto, again, we have a very good moat like pharma and IT. So the ancillary companies are always trade at a 50-60% discount to the main companies, which I think is unreasonable, because the growths are aligned. Only thing is that you are not selling directly, so your margins will be lower than the brand. But for that, you cannot be at 60% lower. So a growth profile is same. So there is a space where the safety is very high and the returns could be substantial. And finally, we have always said that we love platform businesses like the urban companies, the Lenskart and the Swiggies, and we generally try to buy them when no one is looking at them, and we generally try to sell them when the valuations are unreasonable. And finally, power, we believe because of AI, data center and all, power demand will also be very good. So we are playing our portfolio through this, and we believe that this will give us phenomenal results. Next slide, Padma. So Nitesh, will you take the slide? You are on mute.
I'll just brief the audience about the performance. If you see the performance of Sowilo Multi-Cap Fund, across periods, we have been able to beat benchmark, both BSE 500 as well as Nifty Small Cap 250. To be honest enough, Nifty Small Cap is a more closer comparison to the portfolio that is there with Sowilo Multi-Cap as well as Sowilo Target Return Aggressive Fund. But due to compliance issues, we are given choice of only Nifty 50 and BSE 500. So we are showing the performance of BSE 500 as a comparative benchmark. So if I take a period of 3 months, Sowilo Multi-Cap has generated a return of 5.08% vis-a-vis the benchmark of BSE 500 at minus 2.63 and Nifty small cap at 1.53. If I take a 1 year performance comparison, Sowilo Multicap has generated 11.89% return in the last 1 year, where the comparative benchmark of BSE 500 has generated 6.15 and Nifty Small Cap has generated 7.7%. So we have generated a decent alpha of almost about 4.5% across benchmark. If we take 2 year period, the compounded return that the fund has generated is about 10.18. BSE 500 has generated 6.52, and vis-a-vis the small cap, which is a closer comparison, the small cap index has generated 4.66% return. A clear alpha of about 6% over the last 2 years, 6% compounded. 3 years, we are very shortly going to complete our 3 year period, which is on 26th of June. So I'm taking since inception as a 3 year comparison. The 3 year, the scheme has generated 19.36 compounded return vis-a-vis BSC of about 14% and Nifty small cap over 18%. So if you see across period, be it 1 month, be it 3 months, be it 6 months, be it 1 year, be it 2 years, be it 3 years, or since inception, the scheme has been able to beat the benchmark with a reasonable margin.
One point only which I would like to highlight before we open the floor for Q&A is that there are some a short span of period of 2-3 months between October 24 to I think December 24 or so, where still we believe that there is some stress because that whatever was bought at that time, there is some drawdown there still, but we believe that in April month or May month we are very confident, unless some new crisis unfolds, we should be able to do excellent there also. All our stocks, if you see, we have done very detailed work. We do management meet regularly. We don't buy any stock without meeting the management. That is rule number one. And we try to meet the promoter only. And also we do very detailed modeling. We monitor the stocks on a weekly basis. We also go through all the developments in the sector and space. A very large research team is behind all this work. So we are very confident our process is right. There are challenges in last 18 months, but we are very confident that we'll overcome them in next 1 or 2 months. All the big pain which has also primarily happened because of the RBI liquidity tightening in late 2024 from October 2024, I think that is also behind us. So yeah, with that I will request to open the floor for Q&A and we can take the questions. Yes, Nitesh, please go ahead.
See, we have received 4-5 questions as of now. I would request all the participants to please put down their questions on the chat box so that we can address one by one. Sandip, we will probably wait for 2 minutes for the questions to assemble before we move ahead with the quick Q&A session. So we'll just wait for 2 more minutes. Sandeep, I'll start with the Q&A. There's a first question which says you mentioned quick commerce is damaging the traditional modes of FMCG companies. How is our portfolio positioned to avoid these low growth traps in consumer sector?
So if you see our portfolio, except for Hindustan Food, which is a contractor, and that stock, while has remained flat in such volatile environment, has not been able to generate money, honestly. So we don't have any consumer stocks. We have little bit of this quick commerce, which is Swiggy. There also we are very conscious of the valuation. What we are buying is only for the delivery business. We are not assigning any value to the QC business. And I believe that if Zepto doesn't do much damage and to this space, then obviously Swiggy will also get re-rated in a big way. Whatever Swiggy is trading today, in my view, is much lower than even its delivery business valuation if you compare it with Eternal. Yeah. So we are broadly not bought anything which is expensive in our portfolio.
The second question is, you are highlighting, you are very bullish, have a very bullish view on manufacturing and capital goods due to the China Plus One theme. Are our portfolio companies in this space already seeing more orders because of global supply chain shift?
Yes, absolutely. So all the companies, whether it is MNB, Harsha Engineer, Elecon, whichever, their Wellspun Corp, you see huge amount of demand. You see their order books, they are surging like anything, and also good margins. So I think China plus one is real. Second, if our economy has to grow, every industry finally needs equipments and heavy machinery, and that is the reason I think these companies have delivered phenomenal numbers. See, one quarter in 1 year, some of these companies may falter, but broadly, I 100% believe that this is a theme which is not going to die down unless we have a big drawdown in our GDP forecast.
Sandipji, there are two, three questions on. So I'm trying to merge these two or three points to one question. Given the current slowdown concerns and global tech spending uncertainties, how do you see the earnings trajectory of the IT sector evolving over the next 2 to 3 years? And do you believe this is a cyclical phase or a structural shift?
So we were very negative on IT for last 14-15 months, and now if you see, we have become constructive, and the reason is that what was happening, if you see 15 months back when IT index was above 40,000, it was discounting large IT companies at 25-27 times earnings with a 4-5% growth profile, which was unsustainable. Plus AI is deflationary by nature, because I would say this, that we are the least impacted. IT services will be least impacted due to AI, although the biggest impact will be on the ERP companies like the SAPs and the Oracle. But still we will have negative impact of, let's say, 20-25% as efforts go down, but that will be spread over next 4 to 5 years. So if it is spread over next 4 to 5 years, then we are going to see deflation of 4%. So if our companies grow at 10%, we will see 5% dollar growth. But the advantage which has happened is that the PEG ratio, which at 27-28 times was 6 times, today, because the index itself has corrected by 40%, plus the rupee benefit of 12-13% swing, we are going to see 13-14% EPS CAGR for next 2 years at least. And if that is the case, then I think the multiple will be between 17-18 to 20 times. Today we are 30-40% lower than that, and next 1 year down the line, when you go up by another 13-14% and you move to FY29 numbers, you will see some benefit there also. So I think that we have a 25% kind of return in IT index, which is very much possible from here. And that is the reason we have 1 or 2 names which are there, and we have done good in them, the latest editions, and they have done very good for us.
Sandeep, the next question is what FIIs. FIIs have been quite volatile in their allocation to India. What is your view? Drives this flow more today? Global liquidity conditions or India specific fundamentals? And how should investors interpret these movements?
No, 100% it is India specific. So what is happening is that because of the AI raise, as I said, that after 22-23 years, hardware demand has gone through the roof, and because of that, Taiwan, Korea, all these companies have done well, and the people who will use this hardware and finally provide solution like the Mag 7 of M7 in US, they are the beneficiaries, and we have not participated in this race. But as Aryaman highlighted with data that now it is cracking, now the people are trying to find out what is the return on investment. So we are going to see and there will be obviously new innovations which will, I believe, will also bring down power demand substantially, and also the chip demand and the memory demand. So if that happens, then hardware demand will start coming down, and when that happens, then this outperformance which has been there in Korea, Taiwan, and few more countries, that will also start fading away. And when that happens, then you will see reallocation to India. So let me put it this way, that if government cuts tax, long-term and short-term capital gain tax, or if government, if rupee stabilize, obviously we will see more flow. There is no doubt. It is the icing on the cake. But the cake is that we have to be reasonably priced and should have good earnings. And then finally, it has to be compared relative to the other markets. So I think other markets in next 1 or 2 quarters, because of high base effect and this crack in AI, will start seeing drawdown, and we will see a lot of money flowing in India. But remember, I still have my own doubts that it will be in headline index, because as I said, in headline index, lot of sectors are not going to attract money, like FMCG, banking will be selective, IT will be selective. So then, my view is that mid and small cap will attract a lot of money, and large cap, what will happen is that people want to have large cap also, because see, it gives you consistency in your performance. So no one wants to have one kind of product only. So everyone wants to play all. There is a liquidity concern also in mid and small cap. So not everyone can buy mid and small. So wherever large liquidity is required for FII, they will always come in the larger names, but they will be selective. So they will, in my view, they will also go for manufacturing and capital goods and defense. That is what my sense is, and some banking. That is the way we look at it.
Sandeep ji, there is another question on small cap stocks itself, what we were talking about. Small cap stocks saw a 20% drawdown recently due to the rising input cost and a weaker rupee. How are small cap companies we own protecting their profit margins against the rising cost? There's another question on the similar lines. Looking at the current geopolitical risk where the oil prices have gone up, there is a scarcity because of all this thing, oil and derivatives. How are small cap companies better placed vis-a-vis the large cap companies? There's a lot of sense that large company will be able to source their raw materials and meet their requirements, and small companies may not be able to meet those requirements.
No, absolutely. So I 100% agree with the viewpoint. So obviously large cap, because of their balance sheet size, their reach and their ability to buy quantity will always be a big advantage compared to the smaller names and mid-sized names. But that logic assumes that there will be uncertainty and conflict for a longer period of time. If that happens, then I think everyone will suffer because supply shock will be there, as Padma mentioned in one of the slides which she spoke. Our assumption is that this problem will reduce, and if when this problem reduces, maybe 1 quarter, 2 quarter, you will see better numbers from large cap, but then again small cap, because see why we are trying to play small and mid cap. Primarily reason is that their base is small, so their growth and profit growth and revenue growth could be much bigger. There is no reason to say that they are well managed or their corporate governance is better, their board is better, their efficiency is better, their system is better. Nothing. They are probably, in best case scenario, equal or one notch lower than the large cap. Point is that, for example, HDFC Bank, can it become 4x from here? Very unlikely. Can RBL become 4x? I'm just giving an example. Very much possible. So that is the play which we are trying to play, that the base is very important. The base of small and mid cap is smaller, so their ability to absorb shock is low, limited. At the same time, when things turn, they give outsized returns. So that is the reason we want to play, we want to invest more on good quality mid and small cap than large cap.
Another question is, considering current geopolitical tensions and volatile oil prices, how should long-term investors position their portfolio today to turn uncertainty into opportunity?
No, so we have again and again said, and I will reiterate, that if you see data of last 30, 40, 50, 100 years, money is made in a very small period of time. So maybe 2% of the duration. We don't know when is that 2% time or those 2 days. So I think we have to be invested, remain invested, and that is the only way to make money. See, I will tell you, you see any data point, as I mentioned the data point of other countries sometime back, we have done phenomenally better in last 6 years. In last 18 months, we have not done good. So we have to remain invested, and good businesses, they will give outsized returns. I am very confident of that these businesses are good, or if the business is good, it will generate a return.
Sandeep, there are two more questions which we'll take in the interest of the time. Given where valuation and participation stands today, do you think investors are being adequately compensated for taking incremental risk as they move down the market cap curve?
See, obviously, risk and return always have moved in correlation, and it cannot be different. It's basic economics, and no one can deny it. So there is no perfect answer to it, but I believe that broadly, a lot of research has happened over last 100 years, and it has always moved in correlation, and a good correlation. So I will say to trust economics, and it will help.
Sandeep, there is one question on the investor has been there for the last 1 year, but there has been lot
Yes,
of.
I will answer that question. I read. So absolutely, the investor concern and question is right. The point is that the investor has been invested in the aggressive scheme, and there is churn, because of which there is short-term capital gain. But if you see the overall portfolio, there could be some loss, and so they end up paying taxes, but at the same time there is no profit on overall basis. See, I will tell you, we are not doing tax management. So, we would suggest you that it is just 1 year. You keep some patience. I can tell you that we will do very good returns, very good. We never sell just because to book profit. What is the benefit of booking profit? There is a transaction cost, there is tax. We book profit because by not booking profit in the past, we have seen that we have lost huge returns. Like PG Electroplast is a classic example. We sold at 1,000 rupees. It came down to 432 after 15 days of we selling. We did not have any inside information, but we believe 1,000 is unsustainable valuation for them. So please allow us some flexibility to do this. I can assure you that we are not taking any decision to save tax or pay tax. The decisions are pure fundamental in nature, and investment should be done in that sense only. Churning, not churning, I will tell you, if you would not have churn, and if you did not have so many stocks, the portfolios, what you're seeing today, the performance would have been much worse. Because of the churning, because of very thinly spread, the risk has also, so that uh, we have diversified in a very big way at the right time to bring down our beta of the portfolio or the risk of the portfolio. And we will immediately reverse when we see things have stabilized, and we will take much more concentrated bet. So please, we have a very professional 14-15 people research team, and allow us to manage this and trust our process and system. We are not taking any decision based on taxes, and I can assure you it is pure fundamental business decision, and it will you will see the returns. Don't please be impatient in last 12 months. It is 18 months. Our India itself has underperformed in such a big way against all markets. So please give us some time.
Another very interesting point actually is it a good time to top up your investments or stay as it is?
See, I personally put every month whatever
Yes.
money I get as dividend from my existing holding or any other source of income. I will not say this is good time or yesterday was a good time or tomorrow is a good time. See, there will be in 5 years you will get a pocket of October 2024 to January 2024 for 25 4 months period when whatever you put will be down for next 2 years or 1.5 year. I can predict when is that time. Where I believe I have always made wealth by investing whatever I have every day, and I continue with that philosophy. We keep on infusing money whenever we have, and I think that is the best strategy to make money. See, there is such a large team which is seeing every stock market every minute, so you don't need to bother about that. When we put money, we try to put in where we see deep value, and that is our philosophy, and we will do so. I would say that yes, right now if you top up, you will get probably 10-15% extra advantage, but otherwise also whenever you put money, we will try to make money with a disclaimer that if India market is going to underperform by 20, 25, 30, 40% other emerging markets, then obviously we will also not be able to make money. But in the past, this kind of underperformance has always remained for a few months, and then we have bounced back very strongly. The reason is the GDP growth rate along with inflation. We are at 11% nominal GDP growth country. I don't think there are many countries in the world with that number.
Sandipji, I'll probably add from my investor psychology over here. In my career of almost 26 years, I've seen investors putting or opening up their wallets and investing when they see 1 year positive return, 2 year positive return, 3 year, 5 year positive returns of 20 and 25%. The same investors probably shy away when they see negative returns in last 1 year and 2 years. If I take 31st March as a benchmark, it is the negative return. Then last year was about a positive about 2 or 3% return. So honestly speaking, the last 2 years has been negative to zero return for investors. In fact, this is the best time to invest. So rather than investing when you see 2 years, 3 years, 4 years positive return, the best time to invest is when you see 1 year negative return, 2 years negative return. The probability of making a above average return is very high in this scenario.
So, Nitesh, there is one more question which we missed. There is a question: historically, aggressive asset growth in PSU banks has preceded NPA cycle. What's genuinely different this time? Governance, credit filters, just the stage of cycle. Do you
I
expect the
missed it.
PSU banks to continue to outpace the private banks in growth? So, yeah, it is very interesting observation, and this is true that so what the point I was trying to make was not by PSU versus private. I was saying that even for private, it will be tough time because they either will have to compete with PSU banks to gain market share, retain market share, and if they try to do that, they will have to go down the credit profile of the client. In that case, they will not get the multiples. So I think that large part of outperformance of even the PSUs is behind. So we are not investing incremental money in PSU banks. But at the same time, I'm just saying that in private banks also, just don't go by headline number that the valuation has come close to SBI. That is not the right way to look at it, because private banks also have some challenges which is there. So best is to be very selective in that space. So that was the reason I mentioned that. I am not at all saying that at current juncture you should prefer a PSU over a private. That is not the point.
That's it, Sandeepji. That's bring us to the end of the today's webinar. We sincerely appreciate your participation and hope you found the session insightful. Wishing you a wonderful day ahead. Thanks to all.
Thank you, everyone. Thanks once again on coming on a Saturday and listening to our views. Thank you so much.
Should I pause or stop?